German unemployment dropped twice as much as forecast in February. So has the country officially returned to its position as Europe's economic powerhouse? Simon Juncker joins me down the line to discuss. Simon, plunging energy costs while contributing to a negative inflation rate in Germany and the euro area are also providing stimulus. Consumers and investors alike will be hoping this is not just a false dawn. But what do you think? Has the corner been turned?
Well, I think that the underlying dynamics of the German economy is quite moderate, but not suggesting a strong boom in itself. But then we have all these special effects coming on top of that, and that's all giving a substantial boost. But then again, looking at the labor market, it's still quite strong, and as many economists feared and were quite uncertain about the effects of the minimum wage, which was introduced at the start of this year. We are still looking at preliminary data. We don't know much about these so-called mini jobs, which are pivotal in this special discussion. But having a look at the employment figures from January, the unemployment figures up until February, it looks very strong, and it appears that there is no substantial effect on unemployment due to this minimum wage so far, which is quite good news.
German borrowing costs out to 7 years marched into negative territory for the first time. Analysts say this suggests no inflation for the next 20 to 30 years. But why are people accepting negative yields?
Well, to be honest, I don't really know, but I'm speculating here a bit, and I guess that these yields are kind of biased right now, because with the ECB starting its quantitative easing program soon, there will be a huge purchase of bonds by the Bundesbank, which probably means that there's quite a shortage of this asset, as many investors, in particular the pension funds, really are focusing on these type of assets because they're legally bound to invest in safe assets. So this kind of anticipated shortage of this asset may have market participants anticipate a surge in prices due to the QE program, and that makes it possibly quite a good investment for now.
Tomorrow's highly anticipated CPI data will help to paint the inflation picture. But related to the question of yields, is this a temporary phenomenon? Why so?
Yes, insofar as it's possibly connected to ECB QE, it's probably a temporary phenomenon, but the inflation rate plays in as well. And there, again, we have some temporary phenomena. This is the oil price, which really dampens prices currently. But that should affect indirect costs like transport costs and so on, and hence even feed into core inflation later on. So that's still quite temporary, but for a longer horizon, like 1 or 2 years maybe.
Indeed, QE looms and the spotlight has been taken off Greece, albeit temporarily perhaps. But meanwhile, Yellen's testimony caused some relief for market players. With all this in mind, what is your outlook for the euro-dollar?
Well, I'm not really sure, but given that there's quite some heterogeneity about when the Fed is really expected to increase rates for the first time, so there are many people who disagree in the exact timing of that. So that should probably lead to some volatility, but I doubt that unless we have further news on whether they start in mid-year or later that year, there won't be so much movement anymore for the next couple of months until we have this information.
Simon, lovely to speak with you. Thank you for your time. Well, that's all from Simon and myself. Also today, Darren McDermott brings the last Commodities Corner for the week, so please do click back for that. Goodbye for now.